All right, you just turned your investment accounts over to a financial planner and suddenly find yourself asking, wait a minute, how do financial advisors get paid anyway? Hi, I'm Garrett Ray, financial advisor here at the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to tackle brokers versus advisors, advisors versus financial planners, fees versus commissions, and then touch up on some other small topics such as account churning and wrap accounts. Don't forget to hit these like and subscribe buttons you see below if you're so inclined to catch more of our episodes. And okay, Garrett, let's go ahead and get started on this. How do financial planners get paid?
Well, Brice, before we talk about specifically how they get paid, I think we need to establish a little bit of groundwork on what is the difference between a broker versus a financial advisor.
Okay, so that's a great question, and you're right. We would need to lay that groundwork out first so that when we do start talking about how somebody gets paid, how that is associated to what they actually are. So brokers and advisors, those terms are often used interchangeably. And they are similar in that both are tasked with doing certain financial safeguarding or making financial or investment decisions for their clients.
Sure.
But a broker, the difference between them is how they get paid, more or less.
Pretty much, yeah.
And a broker is paid in one way,
right,
while an advisor is paid in another way. So we're going to talk about that in a few minutes. But that's the difference between a broker and an advisor, is more or less how they get paid.
Okay, Brice. So we've talked about how brokers get paid one way, advisors get paid a second different way. Let's talk about a difference, some more groundwork here. What about the difference between an advisor and a financial planner? Can you tell me about that?
Yeah, sure. So an advisor, again, sometimes terms that are used interchangeably, that's understandable in brokers versus advisors. If you're using the term advisor versus financial planner interchangeably, that's a little bit more of a mistake. Yep. So an advisor, again, is tasked with making financial decisions or investment decisions for their client and doing a certain amount of safeguarding for their client. But a financial planner pulls back and looks at the bigger picture. Here's an example. An investment advisor, let's say that your client, you're asking your client about their Social Security filing strategies.
Sure.
That is a question that a financial planner would ask, because they are pulling back and looking at the big picture of everything that has to do with money, incoming money, the assets that you already have, or outgoing money in a household's accounts.
Yep, the overall household, not necessarily limited to investments. We're just talking about the overall householded money. Everything
that has to do with money that comes in or leaves that household.
Okay.
That's what a financial planner would concern himself with. How much taxes they might be paying. What are their pension filing options? Okay. Is now a year to do an IRA to Roth conversion, or would that be 5 years from now? And if so, how much IRA to Roth conversions would it make sense for us to do this year? Those are just the tip of the iceberg of types of questions that a financial planner would ask.
Gotcha.
An investment advisor is not going to generally concern themselves with those things. They are going to simply say, here's the amount of money you have tasked me to invest based on your risk tolerance and your goals. Here's how I'm going to invest it. And I might make changes through that investment year after year, month after month based on that. But they would never consider the questions, what are your Social Security filing options?
Right.
So basically, investment advice is one small facet of what a financial planner does, but it is not the only thing that they do. Whereas that is really what a investment advisor concerns themselves with.
Okay.
So that's the difference between an investment advisor and a financial planner. We had to lay out that groundwork first because, as I said, brokers versus advisors get paid in different ways.
They do.
So I wanted to understand who we are talking about when we start talking about fees.
So, okay, Brice, so we've talked about the differences a little bit here between brokers and advisors, an investment advisor versus a financial planner. Now let's talk about the difference in how they get paid as in one gets paid through fees and one gets paid through commission. So tell me the difference between those.
Okay, so let's go ahead and pull up the chart here.
Okay.
And on this chart, I've broken out those two main categories, client fees versus commissions. Well, even under those, we have some subcategories. So under fees, a fee-based advisor is going to, we'll talk about the less common ones first and then finish up with the most common way that an advisor gets paid through fees.
Okay.
There might be an advisor out there who simply charges you hour by hour for his time.
Almost kind of like a lawyer.
Almost like a lawyer,
like an hourly rate.
Or CPA.
Okay.
I just charge you by the hour.
Just bill in hours.
If it takes me 5 hours to figure out your taxes, I'm billing you for 5 hours. If it takes me 100 hours, I'm billing you for 100 hours.
Okay, makes sense.
Not just per one filing. And regardless of whether that advisor, quote unquote, manages any of your money or not, it might not be that he manages any of it. He just looks at your overall picture and says, all right, for the next 2 hours, I'm going to tell you what my recommendations are. And then you can go out and find somebody else to implement those recommendations.
Okay.
That person could charge on an hourly basis. We show up here on the graph just an example, i.e. $100 per hour. The actual typical average fee that I found on Investment Advisor, Investopedia.com is the average is between $120 to $300 an hour.
Oh, wow. Okay.
Now, this next category under client fees says annual salary. I could have changed that to say project salary, annual salary. Either way, they are not charging you by the hour, but they're saying, okay, for what you want me to do, some estate planning here for you and your grandkids, or we want to take a look at creating a IRA to Roth conversion plan for the next 10 years, that's going to cost you X amount of dollars, regardless of whether it takes me 1 hour to create this plan or
20 hours.
20 hours.
Yep.
I'm going to charge you X amount of dollars. And that can range anywhere, if it's on an annual basis, that could range anywhere from $7,500 to $55,000 for them to charge you, no matter how many hours that takes them. That's a second way that a fee can be assessed on your accounts. Again, those first two, regardless of whether or not they manage any of your money.
Right.
Now, let's get to the third, and this is probably the most common way under client fees, is it's not a dollar amount. It is a percentage of what you see there called AUM. That stands for assets under management.
Okay.
So an advisor oftentimes manages a certain amount of your assets. They take them, you've turned those monies over to them, and they are going to make the best financial decisions for you on your behalf for those monies. Again, they're taking a look at your risk tolerance, the timeline between now and when you need those monies, how much you need them or want them to grow, various questions, and they'll make decisions ongoing throughout that money. Well, then they're going to charge you a percentage of however much they're managing. So let's say you've got $2 million and you turn $1 million over to this financial advisor.
Okay.
And that they charge a 1% AUM.
Gotcha.
1% of assets under management. That means that they would be charging you on an annual basis $10,000 for managing that $1 million.
Okay.
Regardless of what the markets do that year, regardless of whether they trade once or 1,000 times in that account over the year, it is just a flat fee.
Okay.
Of a flat fee based as far as percentage goes.
Right, based on the portfolio size, the fee's
right.
essentially the same.
So if the account goes up in value the next year, then that 1% would be obviously
would be worth more.
Would be worth more. So as you might have heard a common advisor out there on TV saying, we have a unique paying structure. We do better when our clients do better. Well, that's not really that unique. That's
we do well when you do well.
The most common way that advisors get paid. But kudos to them and their marketing that they tell you that's a unique way. Yeah. So we do better when our clients do better. Right. So that means that they are just taking a percentage of the assets that they manage. That's the most common of the three different type of fees.
Yeah. Okay, Brice. So I think you covered fees here pretty well. Help me understand a little bit about commissions.
All right.
Someone who's paid through commissions.
So commissions now, in order to answer that question, the other main way that an advisor would get paid is we have to break that down. Commissions off of what? And there's two main things that an advisor could be getting commissions for. They could be getting commissions for an insurance product. And again, we'll put this back up on the screen here so you can see it. Or they could be getting a commission for securities.
Right. Like stocks or bonds or something of the like.
When we say securities, that's what we're referring to. Anything that's out there in the marketplace.
Gotcha.
So let's talk about the first one, insurance. So a lot of advisors also sell insurance product. They're licensed insurance agents.
Okay.
You could either have affiliated insurance agents, like a State Farm agent might be affiliated with State Farm, and that's the only type of insurance carrier that he's going to use, is State Farm products.
Right.
When a agent or an advisor sells or recommends an insurance product, that might be life insurance, that might be health insurance, long-term care insurance, some type of annuity, fixed index annuity.
Okay.
Whenever they make a recommendation that this should be a part of your overall portfolio, that agent generally receives a commission.
Okay.
But they are not receiving that commission, in almost all cases, they are not receiving that commission from the client. They are receiving that commission from the insurance company or the carrier itself.
Yeah, a little bit of a difference there. Okay.
So again, let's say a client comes to me and says, Brice, I've got $1 million here. I want you to manage that. And of that $1 million, I'm going to recommend that $200,000 go into a long-term care policy, because they don't want to task. I've looked at all their goals and needs, and they really don't want to be a burden to their kids at all whatsoever. They've got enough disposable income, and they've had some health problems with their parents in the past, and they don't want to burden their kids with those same kind of health problems. So we incorporate a long-term care policy into part of their overall financial plan. That long-term care carrier would be reimbursing the insurance agent, or not reimbursing, would be paying the insurance agent a certain amount of money, generally a percentage amount, for having the client sign up for one of their...
For essentially helping to write the business.
Right,
that
for
makes
writing
sense.
the business,
Okay.
right.
Gotcha.
That is, the insurance agent or the advisor should be upfront. They're required to be upfront with you about how much commission they are receiving, but that is not coming... That cost, or whatever the insurance agent or the advisor is receiving, is not being paid by the client. It's being paid by the insurance company.
By the insurance company. Okay.
Having said that, a lot of insurance products, let's pick out, say, a variable annuity.
Okay. Yep.
Might have annual riders attached to it, a fee for being in that product.
Right.
That is not being paid to the advisor by the insurance company. That is being paid by the client
to the insurance company. Right. To have that feature in the investment.
And a lot of annuities or insurance products might have all of those riders as options.
Right.
And you can either have no options in it, which would mean no fees, or a lot of options in it. Might be that if it's worth $100,000, but you suddenly pass away, you might want the death benefit to be $500,000.
So it's like an increased death benefit option. And lots of times that option is called rider in the insurance industry. It's called a rider. Yeah.
So that is something that you are going to be charged as the client, even though the client didn't pay the advisor an initial commission.
That's a good point, Brice. So what you're basically telling me is that there are some fees that are paid to the advisor, and then there's some fees that are also paid to an insurance company. But basically, what you're doing, you're clarifying people how everything's getting paid out.
Yes. And so when I first wrote this episode, I wanted to ask two questions: how is my advisor making money? Right. And how am I being charged? And there's
both good questions.
Both good questions, and they sound like the same question. Oh, wait, Brice, that's the same question. No, they're not. How the advisor makes money and how you're being charged are two different things.
Could
in
be
this
different.
example that I just gave you, the insurance company is paying the advisor for writing the business. So that's how the advisor is making money.
Right.
But you weren't being charged for that.
You weren't being charged in that case.
So we have to really ask two different questions here, and I thought that was a little too complicated. So I left that out of when deciding how to structure this Vault episode. That was one way I was initially. Now I go ahead and say include that in here anyway. But so that's the commission side of insurance.
Insurance. So tell me about securities now.
Okay, so now we're going to talk about securities. And when we say securities, Garrett, what are we talking about?
Basically stocks, bonds, mutual funds, ETFs, that sort of thing.
Those types of things. Anything that can go up or down with the market. Right. That is on the markets. Right. That is when we say as advisors, securities, that's what we're referring to. Insurance products, what we were talking about a minute before, is not securities. Okay, having said that, if an advisor is getting paid a commission on securities, they are not getting paid for the overall amount of the value of the account that they are trading in and out of. They are only getting paid per transaction and the value of that transaction. So let's say that you have $1 million of Samsung stock.
Okay.
And either you or your advisor, together you've made the decision that you should sell $500,000 of that Samsung stock and buy $500,000 of Apple instead. That broker, and that's why I say this is why we had to go back and talk about
you're bringing
brokers.
back the broker thing.
Bringing it back to brokers versus advisors here.
Right.
That broker, if they are getting paid per transaction, that's what they are, a broker, they are going to charge you perhaps a 1 or 2% commission on the amount of dollars that they are selling. So if I said $500,000 that they're selling, they might get paid 1 or 2% on that. Now they're also buying $500,000 worth of Apple. They're making that 1 or 2% commission again.
Okay.
Now, if that's how they are being paid by you, the client,
right,
then they probably are not being paid on the fee basis that we were talking about earlier.
Right.
It's generally one or the other.
That makes sense.
All right.
Okay.
So that now covers the main ways that an advisor slash broker slash financial planner gets paid in one or a little bit of all of those ways. So Garrett, you've been in the business now with us at the Wealth Guardians for over a year. You know it's a very common question when somebody is sitting down with us and deciding whether or not they want to utilize our services.
Right.
How do you get paid?
Exactly.
Well, if you've already met with a financial advisor and you're at the stage where you're thinking of going to them and turning your money, your accounts over to them, and that question is still lingering in your head, it shouldn't be.
Right.
Because they should have been very upfront with you and covered that with you at some point during the planning process and during their proposals and saying, here's how I would recommend having your accounts look like, the allocations and whatnot. They should have talked to you about fees. Yep. And we here at the Wealth Guardians make it very clear. Here's the fees that you're currently paying. Here's the fees that you would be paying if you implemented the plan as we have just designed it out for you. So if you're already at that stage where, hey, I've been talking with this person, I really like them, and that question is still lingering in the air for you, you still don't have a clear answer on it, that might be a little bit of a red flag for you. You have every right to go and confront directly this potential advisor and say, I need to better understand the fees. Now, if you are sitting down with the advisor for the first time and you haven't gotten to that stage, bookmark that question in your head and see if they come full out and address that question before you've had a chance to ask it. That's what we do, and that's what I think any fiduciary financial advisor would do, is cover that topic in whole so that you understand it as much as we've just explained it here. What did I leave out, Garrett?
Well, the one thing that I keep coming back to is, okay, if some people in the financial world are paid per trade, which is what you just explained a broker is.
Yes.
Then what stops a broker from doing a whole bunch of trading just to get essentially paid a lot?
Morals, ethics.
Yes.
That is called account churning.
Okay,
and
that's what you meant by account churning.
That might be one of the fallbacks to that type of account structure or fee structure, or commission structure, is that the only way that they make money is not because you've turned $1 million over to them.
Right.
Is they're only making money when they do a buy or sell. So what is stopping them from, hey, this month I think this is the really good set of securities for you to be in, and then 2 months later they're calling you saying, this is really the hot ticket now.
Right.
So I want to move your assets from here to here. Well, they just made money for themselves by making that recommendation. Doesn't mean that it's not in your best interest. It might be, but you do have to understand whether or not your advisor is obligated to work for you on the fiduciary standard or not.
Right.
And if they are charging a percentage of AUM, if they're on a fee structured basis, chances are that they are a fiduciary as opposed to working on the commission basis. There might be exceptions to that, but again, that should be a question that is easy for you to ask your advisor or your potential advisor.
All right.
Good question. All right. Well, I think that's going to cover it up for this episode of The Vault. Again, feel free to hit that like and subscribe button below if you are inclined to catch more of these episodes. I'm Brice Payne.
And I'm Garrett Ray.
And this has been The Vault.